Picture this. Over the past 50 years, we've poured $1.2 trillion into Africa. That's more money than the entire GDP of Australia or Spain. And yet, more than half of Africa's people still survive on less than $5.50 a day. How is that even possible? Today, we're diving deep into one of the most uncomfortable truths in international development: why decades of aid haven't delivered the progress everyone expected. Part 1. The accountability crisis. When governments stop listening. Here's what most people don't realize about foreign aid. It's not just about the money. It's about what that money does to the relationship between governments and their people. The central problem is this: large inflows of external funds reduce governments' reliance on their own citizens for revenue. When domestic tax collection weakens, so does the bond of accountability between people and their leaders. Think about it this way: when you pay taxes, you expect your government to deliver services, right? Roads, schools, healthcare. If they don't, you vote them out. That's accountability in action. But what happens when governments get most of their budget from foreign donors instead of their own citizens? Take Uganda in the 1990s and early 2000s. Nearly half of their national budget came from foreign aid. When citizens aren't funding the government, politicians stop listening to citizens. Instead, they answer to donors sitting in offices thousands of miles away. Here's the kicker. During the 1980s and 1990s, when major aid inflows were at their peak, Africa experienced some of its weakest periods of growth. Poverty actually rose at the same time that donor funding expanded. The problem wasn't the size of the transfers, it was the political and institutional structures they were creating. In countries where aid made up a large share of government budgets, spending decisions were no longer rooted in what citizens contributed or demanded. Instead, they reflected donor expectations and agendas. The corruption numbers are staggering. Research estimates that roughly $30 billion a year is lost to corruption across Africa. Over decades, tens of percent of aid funds have been diverted away from their intended uses. The project failure rates tell the same story. Up to 70% of aid initiatives either failed to meet their goals or had no measurable impact. We built roads that decayed without proper upkeep, delivered health supplies that disappeared before reaching clinics, and funded agricultural programs that stalled the moment initial donor support ended. It's like running a business that survives entirely on investor money but has zero customers. Without customer pressure, why would you improve your product? Part 2. The hidden economic damage, destroying what we meant to build. But here's where it gets really interesting and really tragic. Aid doesn't just weaken governments. It carries hidden economic costs that most people never see coming. One of the less visible consequences is how donated goods and very cheap imports flood local markets. While the intention is to meet immediate needs, the result is often the displacement of local producers who simply cannot compete with free or heavily subsidized products. Let me tell you about Ghana's textile industry, and this pattern repeats across the continent. In 1990, Ghana had a thriving network of textile factories. By 2010, over 80% of those factories had closed down. What happened? At certain points, the majority of clothing sold in African markets came from outside the continent, either donated or sold at prices far below what local manufacturers could match. Local producers couldn't compete with free, but Ghana wasn't alone. Across Africa, manufacturing as a share of GDP declined from roughly 15% in earlier decades to about 10% today. This contrasts sharply with countries that industrialized successfully, where domestic factories expanded steadily and became the engine of growth. The mechanism is straightforward. When markets are regularly supplied with cheaper external goods, domestic demand shifts away from local producers. Businesses lose their ability to compete. Suppliers of raw materials face falling orders, and investors hesitate to commit capital to industries that appear structurally disadvantaged. The background research confirms this devastating pattern. Periods of large aid inflows are consistently linked with contractions in local manufacturing, not expansions. Short-term relief created long-term atrophy, like feeding a farm instead of letting it grow its own crops. Even the World Bank acknowledges this problem. They've noted that growth in donor support has sometimes undermined manufacturing in recipient countries. What was framed as support for development unintentionally weakened the very structures needed for countries to generate their own export revenues. When productive industries don't mature, economies lose the chance to diversify, to build chains of suppliers and innovators, and to develop export sectors capable of competing internationally. Part 3. The Currency Trap: How Aid Kills Export Competitiveness. Now here's the part that even aid agencies struggle with: the export paradox tied to currency movements. This dynamic is best understood by looking at East Asia. Countries like South Korea and Taiwan built sustained growth by anchoring their industrialization in exports. Their strategy depended on maintaining competitive exchange rates, weaker currencies that made their products cheaper internationally. In Africa, the process unfolded differently. Aid inflows changed currency values in ways that undermined competitiveness. Here's the sequence. Donors provide dollars or euros. These funds must be converted into local money, and that additional demand for local currency leads to currency appreciation. A stronger exchange rate makes exports more expensive for foreign buyers, while imports become cheaper. For industries attempting to break into international markets, this shift removes the price advantage needed to compete. The numbers tell the story. Africa's exports account for only about 20% of GDP, and the continent contributes less than 3% to global trade. Compare that to East Asian economies during their growth decades, which achieved export to GDP shares far above Africa's levels. With currencies buoyed by aid inflows, many African countries remained concentrated in raw commodities, lacking the competitiveness to establish strong manufacturing bases. Despite having a population exceeding 1 billion people, Africa's share of international trade remains minimal, and manufactured exports form only a small fraction of that figure. Currency appreciation produces short-term benefits. Consumers can access imported goods at lower costs, but it creates barriers to the industrial diversification that successful growth models require. Taiwan and South Korea, while receiving some external support, relied far less on aid. Their competitive currencies enabled export-oriented industries to thrive. African economies, saturated with aid, faced exchange rates that undercut their trading position. The very financial transfers meant to support progress ended up discouraging it. Part 4. The Perfect Storm: 3 mechanisms working together. So here's what we've discovered. Aid creates a perfect storm of interconnected problems. First, it breaks the accountability link between citizens and their governments. When politicians don't depend on taxpayer funding, they stop responding to taxpayer needs. Second, it floods markets with free goods that systematically destroy local industries. Entire sectors atrophy when they can't compete with donated or heavily subsidized imports. Third, it strengthens currencies in ways that make exports uncompetitive internationally. This keeps countries locked into raw commodity dependence instead of developing diverse, competitive economies. Each problem reinforces the others. Weak, unaccountable governments can't protect emerging local industries. Destroyed industries can't generate the export revenue needed for economic growth. Uncompetitive exports keep countries dependent on continued aid flows. The evidence is clear. Far from driving growth, aid created patterns of dependence. Despite billions continuing to flow year after year, the expected progress never materializes. Part 5. A better path forward, building real development. Does this mean all aid is bad? Not exactly. Aid absolutely retains a necessary role in emergencies, famines, epidemics, earthquakes, conflicts. When people are dying, you send help immediately. No question about that. But for long-term development, the evidence from 50 years and $1.2 trillion shows us we need a completely different approach. A more effective strategy would emphasize institution building, strengthening rule of law, so contracts and property rights are secure, expanding domestic taxation, so governments become accountable to citizens rather than donors, supporting local enterprise instead of accidentally destroying it with free imports, ensuring that development strategies don't undermine the very competitive advantages countries need. The issue is not the absence of resources, it's the distortion of institutions. Instead of building the capacity needed for sustained development, aid dependence has consistently weakened public accountability, widened opportunities for corruption, and left governments less responsive to their citizens. Conclusion: facing uncomfortable truths. The uncomfortable truth is this. Despite spending over $1 trillion across 5 decades, traditional aid has not only missed its objectives, in many cases, it has entrenched the very obstacles it was designed to remove. The data shows that up to 70% of projects fail, that manufacturing sectors contract during periods of high aid inflows, and that currencies appreciate in ways that kill export competitiveness. These aren't accidents or side effects. They're predictable consequences of how aid actually works in practice. That doesn't make the people sending aid bad people. It makes them human. Humans who believed that complex problems could be solved by transferring money. But the evidence shows that large-scale cash transfers alone have not delivered sustained progress without fundamental institutional reform. Now we know better. The question is, what are we going to do with that knowledge? Should aid be completely reformed, or should we phase it out in favor of approaches that actually strengthen rather than weaken the foundations of economic growth? What do you think? Let me know in the comments below. And if you want more deep dives into topics that challenge conventional wisdom with hard data and evidence, hit that subscribe button. We're just getting started with uncomfortable truths that need to be discussed.